a 30 seconds, 2 minutes or so. Just quickly, I'm hoping everyone can hear me at the moment. If you can hear me, can you maybe just say yes in the chat? Just someone just say yes in the chat, that'd be really useful. Perfect, thank you very much. There we go. Very enthusiastic yeses, that's great. Perfect. Okay, give it a little bit longer just as a few more people come in, but thank you all for joining so far. Yeah, okay. Okay, I think we'll make a start now. 1 minute past one. Other people can drift in if they'd like. Thank you all for joining us today. Our discussion about EMI option schemes and options generally. My name is James Kearns, head of the legal department here at Dragon Argent, joined by Misha Patel and Freddie Brace. Misha is our head of tax, Freddie, head of our corporate and commercial team. Very briefly, for those of you who aren't familiar with us, Dragon Argent provides advisory, accountancy, tax and legal support generally for startups and SMEs. We're a regulated law firm, but we have a full accountancy function and advisory units as well. And we cover off all sorts of law, corporate, commercial, employment, litigation, and others. Today, we're here to discuss EMI option schemes, EMI options. The idea really is just to give a pretty basic walkthrough of what EMI option schemes are, how they're useful, how they should be used, certain pitfalls, any issues surrounding them, kind of practical steps as to how to implement them, and ideas that you should have in mind when considering if they're right for your business. If you have any questions during the webinar, feel free to pop them into the chat. It could be that we cover them as things move along, so you might want to wait slightly longer before you put any questions into the chat, but we'll try and get to those towards the end. The idea is we're going to have a quick discussion now, just a few points, a few questions, and then answer any questions you have towards the end. So great. I suppose we'll start. I mean, we're talking here about EMI options, EMI share options. Before we even talk about what EMI is, perhaps, Freddie, you can explain what actually is a share option full stop.
Yeah, so in a nutshell, what your option is, it's an agreement whereby you can purchase shares at a future point in time for a pre-agreed price.
Right. So you can say to someone, here's an option over 100 shares, and in 5 years' time, you can buy those 100 shares at £1 a share, for example.
Exactly. Yeah.
Okay, great. And so, so that's the basic structure of what a share option is. What do we mean when we talk about EMI options?
So EMI options are specifically tailored towards employees with tax advantages. The employee has the option to buy a share in the future at a price agreed now with HMRC.
Okay, great. So, but they, in all other senses, they're identical to a normal share option, but they're tailored towards employees within certain situations.
Yeah, that's right.
Okay, great. So maybe what would be useful here is to create a bit of a fictional scenario, just a very basic one. Let's say that I'm director of a startup tech company. We've got a very aggressive growth plan. We're developing some B2B SaaS platform, and we want to exit in 5 years, and we really want to get started, scale and grow. We are recently funded. We have taken on some investment, and we therefore can pay developers a salary, but we're not necessarily that competitive in the market. So we've heard good things about EMI option schemes, and we want to take on a tech developer with a maybe a 2% of the company option for that developer. That's kind of a basic background for this scenario. So, you know, first things first, Freddie, I say we've heard great things about options. are they actually the right thing to do generally for companies? What should companies consider? Is equity full stop a good thing to give to employees?
Well, it's not a one-size-fits-all approach. So you do really have to consider both the employer, company, and the employee themselves. So firstly, if you're the startup company, the first thing that I will be thinking about is, are you actually ready to give away some of the control that you have in the company? Because issuing options ultimately results in you allotting shares, which causes everybody to be diluted. And if you don't have non-voting shares as an option, then you're also giving your employees the right to vote in some of the main decisions that the company is going to be making. So that's the first thing that I would consider. The second thing is whether you have the cash flow to use other alternatives. I know you said that in this scenario they don't. So in this case, options would be a great alternative if you don't have the cash up front. That's not to say that there's not an upfront cost at all with options, because there is, and we'll go into what you have to do to prepare your options and your option scheme later. But those are the two main considerations for the company, together with the fact that whoever you hire now might not be the person that you want to be working for your company in the next 5 years. You know that your company will change, it will evolve, it will grow, you'll have different needs, and there'll be different people that can fill those needs. And EMI options are forward-looking. They're largely, the point of them is to keep employees with you for a certain period of time, and that can be anything from, say, 2 years to 5 years, or even further. So that's one thing that you need to consider as well, is that these agreements, they do last a long time. From the employee's perspective, it also needs to work as an incentive for them. I mean, that's the primary reason why you would have an options agreement in the first place. If you can't give them a high salary, this is something else that you want to incentivize them with. Lots and lots of people, they're not really that interested in shares. They want an instant gratification. So you really do have to take the employee's personality into account. Also, think about whether they would actually be able to afford to exercise the shares. If the exercise price is quite high, exercise the option, sorry, if the exercise price is quite high and it's not within their means, then it doesn't really work as an incentive, because they won't have the means to actually use the benefit that you've given them. So you can consider other things like commission-based salaries or promotions or bonuses as well. But there are lots and lots of checks and balances, again, as to whether it's right for you.
And just clarify, the exercise price there is the price they will end up paying when they get the shares in.
That's it, yeah. So the exercise price is the pre-agreed price that we talked about before. That would be in the agreement between you and your employee, and that would set the price that they would need to pay to be able to exercise the option and get those shares in accordance with their agreement.
And I suppose to keep on, as you say, I mean, if the idea behind options is to incentivize someone to stay with you for a prolonged period of time, you may find that your business changes a huge amount over the course of 2 or 3 years, and you might look back and maybe potentially regret incentivizing someone to stay. So it's something which you need to consider. I think a lot of startup companies do this, where they dish out equity quite freely at the start, precisely because they don't have the money to pay top salaries, and they bind employees in when perhaps it's sometimes best for employees to move on. So let's say, just again, go back to this scenario, we've decided this is the right thing for us. We're going to, we want to go ahead and incentivize this employee, this tech developer, with equity. Quick question, Misha, why can't we just give shares, just straight up shares to this employee now? Why do we need to bother with this EMI stuff?
Well, firstly, the employee would actually have to buy their shares, and they might not have that cash readily available. And then secondly, if the company gives shares below the market value, or even gives them to the employee, they'll suffer a tax charge. So it's best to really implement the EMI scheme if you really want to give options to your employees to incentivize them.
Okay, fine. So just to straight up, this guy comes on board, so give him 2% of the company up front. If the company's worth, already worth £5 million, you're essentially giving that employee assets which you have to pay income tax on.
Yeah.
Is it pretty much the equivalent of just giving them a £500,000 bonus up front?
It's basically tax as income tax through PAYE. So okay. Yeah, there's no tax advantages there.
Fine. Okay, great. So that comes on to the advantages of implementing an EMI scheme then. So in terms of directors of a company who wants to implement an EMI scheme, what do they need to consider in terms of the company's own eligibility? Are all companies able to do this?
No, so not all companies are able to do this. They have to meet certain HMRC criteria. So some of being, they need to have a permanent establishment in the UK, they need to have less than 250 employees and less than 30 million gross assets on their balance sheet. Other things they might want to consider is there a high staff turnover in the company or in that industry that the company is located? Do they need to retain them employees and incentivise them? Secondly, are the founders okay with being, founders and shareholders actually in this case, are they okay with being diluted, their shares being diluted when the employee actually exercises these options? And then another thing to consider is, are there enough employees in the company for you to even warrant a scheme? Because it can become quite costly.
Right, yeah, absolutely. So, so those things they need to consider. And is it something which you would ask HMRC to say whether you're eligible, or is it something which you just to meet an eligibility criteria, you take advice and to find out? Yeah,
so companies can come to us, we'll give them advice, we'll do a thorough background check if they're eligible, and then we would put the application together and propose that to HMRC. But that's something we can check for companies if they need us to.
And so just again, Freddie touched on the benefits to the employee briefly here, but can you just work us through how an employee benefits from a tax perspective? Again, using this example, we take on an employee, we give them options over X number of shares exercisable at a certain price at a point in the future. What's the tax treatment for that position under EMI versus an option which is either not EMI or where, as we already talked about, they're just a lot of shares straight out?
So initially under EMI, there's no initial outlay of cash from the employee, and there'd be no income tax on the grant of the options. So when the company grants the options, no income tax and national insurance. When the employee exercises their rights, they'll only pay shares at the pre-agreed market price that we've agreed with HMRC. There'll be no income tax charge on the market value of the share versus the amount that they've actually paid for that share. And then lastly, when the employee sells them shares, they'll only be subject to capital gains tax rather than income tax. And then versus if EMI options are just given outright, the employee would be subject to income tax on the full market value.
If you were just given shares straight, for example. Okay. And then there's sort of non-EMI options as well, presumably ones which don't fall within the EMI scheme. Are they taxed in a similar way to straight?
Yeah, so you can grant unapproved options, and they're basically for, let's say, international employees that don't meet the criteria, or for employees that don't work the working time requirement, which we'll probably move on to talk about later on. And then for them employees, you can give unapproved options, and you can sort of you can add conditions similar to EMI, so you can add performance criteria, or you can add a time-based vesting period for the options. And with unapproved option, there's no income tax or national insurance when they're granted, but there is income tax when the employee actually exercises these options.
Right.
And then when they eventually sell, they pay capital gains tax at 20% rather than the 10% that you would have paid if they were EMI options.
Right, understood. So in that sense, returning to the point around why these are incentivizing to employees is that, if you can't quite afford a top salary and you want to supplement that with options, that's great. But if as part of your options package, you're also presenting them with a tax bill, that's going to be less incentivizing. So the point of the EMI here is to not only give them potential equity and salary, it's also to give them very tax advantage to that option scheme. Great. So in terms of the practicalities here, again, we want to get on with this. We'd like to grant this developer some options. Freddie, what is the process? Where do we start?
Well, the process includes HMRC, which a lot of people tend to flinch at, but it's not as bad as it sounds. So the first thing you need to do is have a valuation agreed with HMRC. That is the valuation of your shares. And that's what companies usually use as the exercise price for the options, so that their employees can get the tax advantage. You'd also need the rules of your scheme, which is a document which governs how the scheme will work. So it will have things in it like when the option can be exercised, what happens if people leave, things like that. That would be your main document, so you need that drafted. You then have your EMI agreement, and that's the agreement between the company and the employee, and you put in there the amount of options that they're getting, or the exercise price is. And most importantly, I find actually, is we need investor buy-in, because your investors, they do like to have a say in this. In lots and lots of companies' shareholders agreements, especially startup companies, there are limits on what kinds of options can be given, what kind of investing they can have, and actually how many options that you can give. So that's always something worth checking, and it's always something worth being upfront with your investors about right at the very beginning, so that they're with you all the way through.
So you talk about valuation. Okay, well, this company here, this fictional company, we just had an investment, a pre-money valuation of £5 million. Can't we just use that? Is that not possible? We've got, does that not count as our EMI valuation as well? Why do we need to go through that?
I mean, you could use that. There's nothing stopping you from using that, except for the fact that obviously the lower you can get your valuation, the less the exercise price will be, which means the less that the employees will have to pay to exercise the options. And what HMRC do when they give you a valuation is they give you two different types of valuation. One is called the actual market value, and that's the actual market value of the shares right now. The other is called the unrestricted market value, and that's usually a bit higher, and that takes into account everything that the AMV does, plus the fact that there wouldn't be any restrictions on the shares. So it assumes things like the shares are liquid, the shares aren't subject to any particular restrictions in the company's articles, anything like that. It ignores the fact that you might be a minority shareholder if you had these shares. Basically, it's the ideal valuation, and a lot of companies do get confused, and they do think that they have to use this higher valuation to set the exercise price. And I'm sure Misha will correct me if I'm wrong, but it's actually the AMV, the lower valuation, that you need to set your exercise price at. So it's really important to know the difference.
Misha, quickly on that. So if you were to set the exercise price lower than the AMV, what's the situation there?
So that would trigger an income tax situation. So that basically what would happen, you wouldn't get the tax treatment of the capital gains tax when you go to sell.
Right.
You would end up paying 20% rather than 10%. And then there would be an income tax charge when you exercise the options. Between the income tax charge would be between the AMV set and the market price.
Right. There's nothing technically stopping you setting it lower, but there would just be tax consequences if you do. But the ideal situation here is you go to HMRC, you get an AMV, an actual market value of say £3 per share, and then when you go to draft your documents and grant these options to employees, you set an exercise price of £3 per share. That way they get all the benefits of the tax treatment. So going back to what we're saying, then there's obviously different types of valuations. Evaluation from an EMI perspective is actually very different for evaluation when going out to investors. And going out to investors, often you want to drive it as high as possible, but with the EMI, you want to drive it as low as possible. So on that point then, so okay, we've got this valuation, we've set up, we draft all the scheme documentation, and we can grant these options. So, I mean, do we then use that valuation forevermore? I mean, how does that work?
No, so the valuation only lasts for 120 days. And within that 120 days, you would grant the options to your employee. And then from that, the day you grant the options to your employee, you then have another 92 days to register them options with HMRC. So we would suggest doing valuations either every 3 months or every 6 months. We wouldn't, unless you have options to give, we wouldn't say do a valuation.
Right. So it seems to me, because I mean, again, if you have to refresh your evaluation each time, that's obviously a cost to the business. So presumably, are you saying essentially that what you should do is, if you're going to grant options, grant them in batches?
Yes.
Try and get as many employees in at the same time and grant as many options as possible based on evaluation, because it's going to run out in 120 days. Understood. Okay, great. So let's return to this scenario then. We understand what the process is. We're also aware that we should probably include more than one employee on the scheme, because otherwise it seems to be quite onerous in terms of cost. but we're confident this tech developer we want for the long haul, and we want to keep him until we exit, because that's the plan, is to sell in 5 years. We also want to bring in an operations specialist for a sort of fixed term project with very specific targets. And again, we want to incentivize her by using equity in some way. So we've got two different situations. One, we want to keep, we really want to retain until the end. The other, if she comes in and does a great job and completes this project, fantastic. But we want to incentivize both of them with options if possible. So Freddie, how will we approach this? What options are available to us to incentivize one in one way and one in another?
So EMI options, they're quite flexible in that respect, and you can make them as bespoke as you need. If we're talking about incentivizing someone to stay for a length of time, then you'd want to be thinking about the vesting of those options. And there are two things to think about there. One is whether you would like them to vest over a number of years or months, probably in this case years, if you want them to stay for a long period of time. So you've got that, and then you can also have what's called a cliff, whereby for a year or perhaps even 2, none of the options will vest. So that gives the employee an incentive to stay for a minimum period. And then coupled with that, you can also think about the exercise of options. So for example, you can have an exit only plan whereby not only do they have to vest over a number of years, but they actually can't be exercised until an exit. So obviously the employee is more incentivized to stay longer. In terms of performance, you can have specific performance targets and tie this to the option so that they can only be exercised, or the shares only vest upon hitting certain performance targets. And the important thing about those when thinking about them is to have them as clear and specific and measurable as possible, so that you avoid any disputes obviously later on as to whether the performance targets have actually been hit.
So just to go back to this concept of vesting, so just to put it into terms, right, we've got this guy we want to keep, and we say then that his options will vest over a period of say 3 years. What does that literally mean? So he's with us for 3 years and then what? Or if he leaves after a year, then what? I mean, how does it work?
So well, it depends what you put into your agreement. Again, so because you can make them so bespoke, there are lots of different things that you can do. But what we see commonly in various agreements are the concepts of good leaver and bad leaver. And they determine what happens when somebody leaves. So you'll have a category of people who are good leavers, and that's usually people who resign for illness or it's been mutually agreed by the company. And you might say to them that you can exercise your vested options. So when we talk about vested here, we mean options that have the right to exercise them has been earned by staying for that period of time for them to vest.
So for example, let's give a very clear example on this. You've been granted options over 300 shares, which vest over a 3-year period, 100 shares per year. So if you stay for 3 years,
the whole 300.
300. If you stay for 2 years, you get 200. Stay for 1 year, 100. Is that basically?
Yeah, that's it, exactly. But obviously that can change depending on what you put in your agreement. So I talked about good leaver a second ago. The opposite is bad leaver. So if somebody leaves because they've been dismissed or they've done something which is really bad conduct or something detrimental to the company, you can make it so that even if those shares are vested, if they haven't been exercised, they will completely lapse and they won't be able to exercise any of those shares.
I mean, again, we want to be, this company, going back to the scenario, we want to be competitive. Do you consider there to be a sort of a market standard, or is it just for this kind of arrangement?
Yeah, so commonly the market standard is if you're a bad leaver, you don't get to keep any of your options. You don't get to exercise them, and that's that really. If you're a good leaver, you're usually able to keep and exercise the options that have vested, so that you at least walk away with something that you've earned by staying for the period that you have. A lot of times it's quite difficult to judge what will be appropriate in the scenario when it comes up. So one thing that we do recommend is always putting in some flexibility for the company. So we'd usually have a line that said something like save where the directors determine otherwise, so that you've always got that flexibility in there, so that if somebody falls into a bad leaver category or a good leaver category, but you want to be more lenient with them, for example, you're able to do that.
And is there a market standard in your experience around vesting periods or cliffs and anything else like that?
Yes, so the current market standard that we see a lot is to have shares vest over 4 years with a 1-year cliff. which means that nothing vests in the first year, and then the options will vest in equal instalments over the next 3 years.
So that covers the kind of the time period. Going back to this operations specialist in the scenario here, how does that work then? I mean, let's say for ease that she's brought on board and there are quite specific, there's 4 specific milestones that we need her to reach. How would that be structured in the agreement? How would her shares vest or options vest in that scenario?
Yeah, so you would set out those performance targets in a schedule in the agreement, and you would decide as the company how important those performance targets were to you, so that you could allocate the amount of options that would vest in relation to each one. You could have it so that the bigger the performance target that's met, the more options that vest. You could have it, for example, if the performance targets are linear and they are just milestones, you could have options vest equally for each one. So the opportunities are endless, really. It really depends what the company is trying to achieve and how you get that across.
And I think you mentioned about exit only. What does that mean?
So an exit only plan means that the employee can only exercise their options when the company comes to an exit, which is usually a sale or a listing. That means that obviously nobody is able to be allotted those shares under the option agreement until that happens. That's in contrast to people who are allowed to exercise immediately after their shares have vested. So they'd be exercising in bits along the way. You usually don't recommend doing that unless you've got a specific commercial reason, because it's a lot of admin to just keep allotting them along the way. But there, obviously, like I say, there are performance targets and other circumstances in which the options can be exercised. But it really depends what the company wants to do, and exit only is one of the ways that the company can keep its cap table as simple for as long as possible, and then give everybody what they deserve at the end when there's going to be profit for everybody.
So I'm presumably coming back to a question we touched on earlier here. Exit only, I mean, when a company asks itself whether it's worth actually giving out options, a company giving exit only options really should only do so if they have an exit in mind. It seems like an obvious point.
Yeah, exactly. Yeah, I mean, the whole point of this is that it's an incentive. And if you're telling the employee that they're not going to get their incentive unless there is an exit, and you don't think that you're going to have an exit in, say, 5 to 10 years, is that really an incentive then? And that also ties into corporate governance and things around that, and being transparent, because you need your employee to buy into this as well. So if they can't see where the company's going, that may affect whether they see this as an incentive.
And similarly, just forgetting a company which is seeking an exit here, but you have someone who exercises options for their service after 3 or 4 years. There's no exit in sight, there's no exit planned, and the company isn't particularly profitable. An employee sitting on 2% of the shares, is that particularly incentivizing either? If there's no dividends inside.
Exactly, no, not really. Yeah, so it really does depend on whether you think there is growth available within the company. You have to really think and plan that your cash flow is going to increase, because otherwise, as you say, the employees aren't really going to get a lot of benefit from that, and it could even be disincentivizing rather than incentivize them.
And again, to hammer the point home, 2%, it doesn't give you any influence on the company either in terms of voting.
No, exactly. No, you wouldn't be able to pass anything or reject to anything really.
Okay, great. So again, in this scenario, we've got a very specific plan. We're looking to exit, so hopefully it's incentivizing for everyone we grant options to. But let's just say, I mean, just in terms of potential dangers, potential risks, this star tech developer we've taken on board and granted options to, after a couple of years, he asked if he can go part-time, as an example. Any issues?
Yes, so there is a working time requirement that HMRC require employees to meet, and that is working 25 hours a week, or at least 75% of their time, working time. So if the employee doesn't meet their requirements, they could lose their beneficial tax treatment. Some other things that could negate the whole tax treatment under EMI is if the option contract is signed before the employee actually starts their employment date, the start date. Other things could be, if, like I alluded to earlier, is if the exercise price is set below the AMB agreed with HMRC. There are other admin requirements that are required. So like I said previously, the options have to be notified within 92 days of granting them to an employee. If they're not notified with HMRC, you could lose your EMI tax treatment.
Right. And is there a danger as well around performance targets, about amending those, and is in terms of how that has an impact on EMI eligibility?
Yes, so any changes to the option agreement can impact the EMI tax treatment that an employee is eligible for.
Right. And in terms of just ongoing admin, I believe is it an annual return that needs to be filed? I'm just thinking about just how onerous it is for companies to maintain these things.
Yeah, so there's an annual ERS return that needs to be submitted by the 6th of July. And on that annual return, the companies would essentially tell us which employees have exercised their options, if any options have been cancelled or any lapsed. So we would need to notify HMRC every single year by the 6th of July for any changes that have happened between the 6th of April to the 5th of April.
Right, understood. Okay, great. So just to completely change things for a second, let's just imagine that this company, it turns out for whatever reason is not even eligible to grant EMI options. Freddie, are there any alternatives for a company in that position?
Yes, so there are a couple of different alternatives. Again, it's really a balancing exercise for the companies to which they choose to use. But as Misha's already mentioned, you can give unapproved options, but given that they're not tax advantaged, that's probably not a great thing to do. You could also issue a class of share that we call growth shares, and this actually enables the employee to share in only the growth of the company. So the value that they get is ring fenced. So, for example, the company might currently be worth £100,000. Your growth share would entitle you to, say you've got 10% of the company, 10% of anything above that £100,000. So that's a way of getting your employees, one, on board in terms of incentivisation, and two, to really push for growth of the company. So sometimes that works as a really good incentive. Other things to think about actually from an employment perspective are things like perhaps a commission-based salary that ties in with performance targets. So if you can't give a very high salary to begin with, but you might be able to, and that's dependent on the profit that this person makes, then commission-based salary is a really good idea. Obviously bonus payments, but again, that doesn't really have the tax advantages that EMI options do. And also just getting to know the employee and what makes them tick, because it may be that a simple title or a promotion could actually really incentivise them. You could use things such as, and I know it sounds silly, but employee of the month, things like that, they all do help. So it really does depend on what personality your employee has and the resources that the company actually has to offer.
So just briefly on growth shares then, that's something which, I mean, if you issue growth shares to someone, why would it not attract the tax liability that would be attracted if, when we talked about it earlier, just dishing out shares to someone, would there not be a tax liability on the issue of the growth share?
Well, they don't receive the immediate return. So they only receive their value at the end. Mm-hmm. So when there's a sale or when the company has grown, that's when they receive the value. That's why it's ring fenced above what the company is already worth. Misha might be able to explain that in a more efficient way than me, but that's why, because they haven't gained anything currently when those shares are issued.
Yeah, no, I completely agree with Eddie. They'd only make a gain when they've exceeded that hurdle, that valuation of the company, and that's when they would make that gain.
Okay, and is it more kind of cumbersome to implement growth shares than it is EMI, or are they similar kind of levels of process there?
I think it's hard to compare the two because they are such different things. But EMI options, they probably, I would say, are more straightforward, just because growth shares, you do need to amend your articles of association to account for them. You do really need to think about what the hurdles are going to be. If you have one set of growth shares, which makes sense now, in 2 years' time, the same threshold might not make sense then. So then you'd have growth shares on top of growth shares. So it can become quite complex, and it is something to think about. But in terms of overall, whether one's more cumbersome than the other, I would probably say on balance, they're about the same. But growth shares may be a little more complex in relation to valuation and having to change that as you go.
Understood. I think I was going to ask one more question, briefly going back to EMI options, and then probably move on to kind of wrap up with the conclusion. If in the meantime anyone has any questions, please put them into the chat now, because while we're just wrapping up, then we can review those questions. If not, then great, but please feel free to put any questions into the chat. But I was going to just briefly return to something you touched on earlier, Freddie. You referred to investor buy-in. And I suppose this is kind of a sort of a broader conversation around when companies are negotiating with VCs or negotiating with any kind of institutional investment. What kinds of conversations tend to happen around option pools, EMI? I mean, can you give a bit more?
So the usual things that we often see that investors like to have a say in is obviously the size of the option pool, because that's the maximum size by which everybody is going to be diluted. So they want to be clear on that, and they want it to be certain. And things like the vesting period of options, again, is something that they like to have buy-in on. They want to know that you've got something in place that is incentivising your employees, but that doesn't go on forever and ever, so that an employee can suddenly come out of the woodwork and dilute you all. Things like good leaver, bad leaver clauses as well. They often like to see those in agreements, and that's often one of the requirements that they put into shareholders' agreements. Again, they like to know that the company, whilst it's being generous, is also being sensible about what it's doing, and that there is a way to get rid of bad employees without them walking away with that advantage. So things like that.
Okay, so they set quite strict.
Yeah, they do set quite strict requirements. Usually you'll have in your shareholders agreement that they can be changed if you get investor consent. So again, this is why it's really important to open up the negotiation as early as possible and get them on side, let them know what you're thinking commercially, and they can probably help you. They've been through the same process. You know, they're not unreasonable. And in our experience, if a company can back what it's trying to do, an investor is usually open to that.
And in terms of size of option pool, does that vary?
It does vary. I would say standard is probably about 10 to 20%. Any more than that, and I think you're probably pushing for the investor buy-in there.
We've had a couple of questions come in actually. One for you, Michelle, probably a couple for you, Michelle. Could you please describe the process of valuation of the options in a little more detail?
Yes, so for the process of valuation, we would obviously liaise with the company, see where they are in their journey, see exactly how, if they've done any external raises, because that does impact the valuation. In terms of the valuation, submitting to HMRC. So currently we would submit the valuation to HMRC. They would turn around the valuation within about 4 to 6 weeks. Once we have the valuation back from HMRC, that's when we would look to draft up the option contracts. But in terms of actually agreeing the valuation price, it's something that we can't just say, you know, we're going to do your valuation at X amount, like £1 a share. We'd have to look into exactly what the company's been up to, where they've raised, if they've raised under SEIS or EIS, because that can really impact the valuation.
And what other factors are considered? Presumably, if a company's revenue generating?
Yeah, so if it's loss making, the valuation is slightly different. If it's profit making, you could probably achieve a higher valuation, just because obviously companies on the stock market, you know, they have an actual attributable value. Here we're looking at companies that don't have any value attached to them right now. You know, we're going off previous external investment, and there could be other impacts. You know, their shareholders articles and stuff like that could impact the valuation. But
in terms of, have you seen, I mean, maybe there isn't one, but let's say, you know, the company's just gone out, taken on investment at £10 per share.
Yeah.
I mean, how much of a discount or what range of discount do you tend to see for EMI option valuations?
So typically at the moment, HMRC are quite flexible, but we usually go with a 90% discount if we can really justify that from what the documents that the companies provide.
90%?
90%.
Okay, great. So yeah, if you've gone out at £10 per share, then £1 per share is quite feasible in a lot of situations. Exactly. Okay, great. There was another question. I don't know, Misha, if you're able to chip in on this. Anything about self-employed? Whether to the extent to which EMI can be applicable in that situation?
No, not at all. For a self-employed individual, you'd look to give unapproved options.
Okay.
Yeah, so that there wouldn't be many tax advantages there.
Okay, great. Yeah, I was going to say just a few words in terms of wrapping up. Again, if there are any other questions, please put them in the chat now. But I thought just by way of summary, we just look at again, just sort of consider what's been said today. I think a really key point that comes across here is making that initial decision as to whether options are right. I think we come across clients quite a lot who I think are in a particular space. They are a startup, and I think they kind of sometimes just assume that options are always the right thing to do because that's what's done in the industry. And very often it is the right thing to do. But for various reasons, it doesn't necessarily do the job it's intended to do. The point about EMI options are to incentivize specific employees to do specific things. And again, as we said before, you might want to incentivize someone, you might want to bring someone on board on day one who is perfect for the role, but is not perfect in 5 years. So you don't really want to incentivize someone to hang around for 5 years if they're not right for the role for that duration. Similarly, unless you've got an exit plan, or unless you're going to be profitable and be distributing dividends, you have to consider whether equity is something which is in any way incentivizing to employees in the first place. If in 3 years an employee can get 2% of a company which never distributes any dividends and which has no sale in sight, what really have you given that employee? That employee would rather have a higher salary than sit on 2% of a company which, you know, is not going to give any value back from those shares. So I think that's always important to take that initial step back and decide. But once you have decided, and in certain situations, in many situations, they're the perfect tool to incentivize employees and to align the ambitions and the trajectory of employees with that of the company. If the company is looking to grow and looking to exit, then you want to incentivize employees to help the company grow and to help the company exit. So if you can align those objectives, EMI is a perfect tool for that, and it does so in a very tax efficient way. And again, if as many startups and SMEs are, if they're in a particular space where funding is tight and they can't go out and pay top whack for a great developer, this can be a nice supplementary add-on to it when trying to attract that top talent, and it can make the difference out in the employment market. Similarly, again, aside from the tax issues, the good thing about options is you can keep your cap table cleaner for longer as well, rather than dishing out shares like sweets on incorporation and having multiple names on your cap table, which will always raise eyebrows with investors, VCs, etc. You can have a nice, neat option pool with people falling in and out, which keeps your cap table clean with just founders and investors. So, as I say, as I hope we've shown, EMI options can be a really useful tool. There is a bit of a process, but it's one that the reason there is a process is because they are so beneficial from a tax perspective, and that's why HMRC make you jump through certain hoops. But it is pretty straightforward, and it's something that we can certainly assist with if you have any intention of implementing a scheme. The plan is that we're going to send a follow-up email to everyone with a link to a recording of this webinar, also details as to how you can get in touch with us as well. If you'd like to schedule a call with one of us, we can speak to you more specifically about your requirements and how we might be able to help you. So unless there are any questions, I don't see any more coming through. I think we'll wrap it up now a little earlier than intended, so hopefully you can crack on and have some lunch. So thank you all for coming along, and as I say, please do get in touch if you'd like any more help. Thanks so much.